Let's start with streaming video. You know that so well. You helped amass that really armada of material, the content that Disney has now. We saw Netflix took a bit of a stumble. Disney subscribers, we don't know, they go up and they go down from month to month, quarter to quarter. But overall, are there too many players in this space? Does there need to be some consolidation or shaking out?
Well, nice to be here, David. Thanks for having me, as always. It's a pleasure. I would say the market for these streaming services on a global basis continues to grow. So I think you're right to point out that some months are higher and some are lower in terms of subscriber growth. And there's something called churn where people, subscribers end their subscription either temporarily or permanently. So there's ins and outs of the business. And the U.S. market, where you are and I spend most of my time, has seen some maturity because these streaming services have been around for a long time. But if you look globally, there are many markets around the world where these streaming services are just being launched or still have a lot of growth in front of them. So I think you'll see on a global basis a fair amount of continued steady growth for the leading services. Having said that, not all of these streamers that have pretensions of being a big global successful player can make it. You have the big guys. You have Netflix, obviously. Disney Plus is already a success. I can't see that being dislodged in any way. HBO Max, Amazon through Prime has over 100 million subscribers. So there are big players. The question is, on the margin, some of these smaller players who are trying to make headway globally, can they do it? And I think you'll see some consolidation and some people just falling out over time.
Thus far, we've seen sort of a growth industry, and it's in an investment phase. People are not talking about profits, making money off of it. They're talking about investing in order to acquire those subscribers you refer to. At some point, there has to be more maturity. Can these enterprises continue to invest in new content at the rate they're investing right now, given the revenue structure?
I believe they can. There's still a lot of headroom for continued investment in content. Netflix is spending probably almost $20 billion a year on content. I think the Walt Disney Company said in their last earnings that they spend, including sports rights and movies and television shows around the world, like $33 billion or something like that. It's a lot being spent. The appetite from consumers is voracious. And I think that will continue for the foreseeable future. It's been double-digit growth in demand for content for these streaming services around the world.
Kevin, some people have said that this streaming is sort of like the next thing after cable. We had broadcast, then we had cable, now we have the streaming. But there's one way it strikes me that it might be quite different, and that is how sticky the revenue is. In cable, as you know, at ESPN, as I recall, those rights agreements could go for multiple years, 5, 6, 7 years. You knew that revenue was coming in. Even in broadcast, so much of that's bought, at least for a year, you know it's coming in. Subscribers can come and go month to month.
They can, and they do. But again, I think the penetration rates, the overall level of subscriptions is progressing nicely in almost every territory.
Kevin, what has this streaming phenomenon meant for the cost structure of producing new content? I mean, I remember Dan Burke, who used to run Capture Things. He said, sooner or later, all the money goes to the talent. What is this doing to what people are paying for writers and producers and for cast, for on-air talent and below-the-line talent?
Well, I think John Landgraf of FX called this peak TV, and that was a few years ago, and it continues to keep peaking. It's great. I think it's great news for the creative community. The more creative output that is required and the more valuable their services are and their talents, it's good. I do think there's plenty of headroom here for profitability to be shared among the players, talent, writers, on-screen talent, the streaming services themselves, and the producers of the content who manage the whole process. There is no lack of profitable headroom there. I think that's this is one of kind of a win-win-win situation that's happening now.
So Kevin, who wins in the end? Is it the one with the most toys? And by that I mean, for example, going back again to Disney with the acquisition of Fox on top of what they already had, they have an awful lot of content. Is it a game that goes to the person with the most content?
Content itself, you have to have content that appeals to audiences. I guess that's obvious. It goes without saying. Disney is the premier content creator on the planet, I think. And they have the brands that matter. They have the stories. There's ongoing stories with Marvel and Star Wars, and of course Pixar, which tells fantastic stories, and Disney itself, and the Fox, the Fox acquisition, as you said, which came along with National Geographic and the Fox branded TV studios. Great set of content. They are going to be a big winner. Those are brands that will continue to grow in value and resonate with audiences forever. I also think Netflix, has a model that's very difficult to repeat. They're a volume play. They have great product. They make a lot of it. It would be hard for another player to replicate that breadth of content, I think it would be hard, David, to find a consumer segment, a meaningful consumer segment for which Netflix doesn't have an incredible depth of content. And recreating that dynamic again would be very difficult.
Kevin, let me turn to a different part of your world here and talk about the really drop off $300 billion, as I recall, got dropped off of the value of Meta because of Facebook. And part of what we heard when those earnings came out was they're going to have to change their whole model, that they are going to have to go into video. Yes, once again, video, because they said they really are competing with YouTube and TikTok. In particular, you for a time ran the U.S. TikTok operation. So what does that mean for them to have to go into video?
Well, look, they've been in video, and this is user-generated content. These are the users, the audience themselves make videos. So they're not paying for the video, but there's a lot of bandwidth and there's a lot of expertise that goes into and tools that allow creators to make high quality videos. And then the delivery of those videos in a stream, one after the other, requires an intensive version of artificial intelligence to make sure that you understand a customer's preference, a user's preference in real time, and can deliver the right video to the right consumer in the right sequence. That is extremely difficult. It's, Facebook has always, and Instagram, the other part of Facebook, has always depended on follows. You follow someone, you like their stuff, that's a very strong signal. And if you look at TikTok, it's a very weak signal. They look at the nuanced usage of the app and determine your preferences that way. And if they're going to compete against TikTok, they're going to need to get much, much better in artificial intelligence. But I also think the Facebook story doesn't end with competition and having to move over to video. There's a big issue with their ad targeting business. A lot of their revenue comes from, a lot of it is direct to consumer services, both for e-commerce and video services who are trying to acquire customers. And the rule changes on Apple and the privacy changes that we're seeing across the globe, most of it for very good reason, is making it more difficult to target those ads. And so it's getting much more expensive for advertisers on Facebook to reach their audiences. And that is a very substantial problem for them. So I think it's a multifaceted issue they're facing. And there's no easy solve, but they're an incredible company, and Cheryl and Mark are super smart, and I'm sure they'll figure it out.
Yeah, I mean, listen, let's be clear. It's a very big, very successful, very profitable company. At the same point, is the valuation off at this point? Because I wonder if the stock price really was based on an assumption or a set of assumptions that may no longer be true.
It might very well be, that might be the case. And look, that's already reflected in that valuation change that happened. Look, it's a competitive marketplace. TikTok is going to make big inroads with advertisers. Amazon is kind of a sleeper. They have a huge advertising business, both in their e-commerce ecosystem and outside of it. So the competition, which used to be Facebook and Google, and then everyone else, is now Facebook, Google, Amazon, TikTok. It's a competitive, the competitive intensity is increasing quite dramatically. And I think you're seeing that reflected in the stock price. And who knows where the valuation goes? I don't, pick stocks well. It's never been my core talent, but it is clearly there's reasons for that big drop, and it's going to be very interesting to see how the future unfolds for them.